Now, it's good to take note that a situation may arise, like I said before, a situation may arise where at maturity there may be a situation about the redemption or about the repayment of the bond. There may be a situation about the repayment of the bond, in which case it may be possible that while the agreement was negotiated, it was agreed that the bond would be either redeemable at par, which is what we have done. If it is redeemable at par, the maturity value, which is this 1,000, the maturity value, which is this 1,000, would be the same thing as the face value. That's if it is redeemable at par. The maturity value will be the same thing as the face value. There may also be a situation where the bond may be repayable at a premium. If the bond is repayable at a premium, it means that the maturity value will not be the same thing as the face value. It simply means that the maturity value will not be the same thing as the face value. The maturity value will not be the same thing as the face value. If the bond is redeemable at a premium of 5%, for instance, it means that if the bond is redeemable at a premium of 5%, for instance, if the bond is redeemable at a premium of 5%, for instance, say the premium of 5%, for instance, this simply means that this 1,000 will no longer be 1,000. It will now be, we calculate 5% of 1,000, which is 50 naira. That will mean that the maturity value will then become 1,050 naira. So in that case, this value here will change and become 1,050 naira. While this value will also change and become 1,050 naira. Notice that all these interests have not been affected. All these interests, all these 5 years interest have not been affected by that clause that may have been inserted, whether it is redeemable at a premium or it is redeemable at par or it is redeemable at discount. What has only been affected is the face value, which is the amount that the borrower agreed to repay. The face value is the amount that the borrower agreed to repay. So if there is a further agreement that bond will be repaid at a premium, it means the borrower has agreed to repay at whatever percentage higher than that face value. In this case, they are giving us a 5% premium. It means that the borrower has agreed to repay the bond at 5% higher than the face value. And if we calculate 5%, we find the figure to be 50. It means that instead of repaying 1,000, the borrower has agreed to repay 1,050, which is 50 naira or 5% higher than the face value. So in that case, this figure will change and our answer will change. The same thing if there is an agreement that the bond be repaid at a discount, say 10%. That simply means that discount of 10% simply means that the borrower has agreed to pay less, 10% less than the face value, in which case the borrower will be paying 10% less than the face value, which is 100 naira. It means that the borrower will be paying 900 instead of 1,000. It means that the borrower will be paying 900, and of course if you do the workings you will realize that the figures cannot be the same. There may also be a situation that we call multi-period interest payment. There may also be a situation that we call multi-period interest payment. In the multi-period interest payment, so it is important to also take note that we can have a situation of multiple interest payments, or what we call multi-period interest payments, in which case interest will be paid more than once in a year. the example we had before was with the assumption that interest is per annum. We had the 10% interest per annum. But it is possible for the situation to be that interest will be paid more than once in a year, in which case it is called multi-period interest payment. And like our example where we had a 5 years 1,000 naira bond with interest at 10% and yield to maturity of 15%. 10% per annum, yield to maturity of 15%, where we were looking for the pricing, the appropriate pricing. Now we can have to determine the appropriate pricing when interest is paid more than once a year. Let us assume, for example, that interest is paid quarterly. Let's assume that interest is paid quarterly, which is 4 times in a year. Meaning that if you have years 1, 2, 3, 4, and 5, and interest is paid quarterly, it means that in year 1, interest will be paid 4 times. Interest will be paid 4 times. In year 2, interest will also be paid 4 times. In year 3, it will be paid 4 times. And so that by the end of the 5th year, interest would have been paid 20 times. So by the end of the 5th year, interest would have been paid 20 times. So what we do is to come back to the formula PD equals to summation NT equals to 1 R at time T into 1 plus yield to maturity raised to minus N plus maturity value at time N into 1 plus yield to maturity raised to minus T here and raised to minus N. So what we do is to come to this formula and adjust for the number of times interest will be paid. So I will come here and adjust for the number of times. And the number of times interest will be paid per year, I will represent by the alphabet M. I will represent the number of times interest will be paid per year by the alphabet M. So I can come back to this formula and adjust for the number of times interest will be paid per year. I said I will come back to this formula and adjust for the number of times interest will be paid per year. So I come to the yield to maturity divided by the number of times interest will be paid per year, and multiply this by the number of times interest will be paid per year, and do the same thing here. So that what I will have will be my price of the bond to be equal to 100 as we calculated for R into 1 plus 0.15 divided by 4 raised to power minus 1 times 4. That is for the first year, plus 100 into 1 plus 0.15 divided by 4 into minus 2 times 4. That is for the second year, plus 100 into 1 plus 0.15 divided by 4 raised to minus 3 times 4. That's for the third year, plus 100 into 1 plus 0.15 raised to power 4 divided by 4 raised to power minus 4 times 4. That's for the fourth year, plus 100 into 1 plus 0.15 all over 4 raised to power minus 5 times 4. That's for the fifth year. Then plus 1000 into 1 plus 0.15 divided by 4 raised to power minus 5 times 4. This component is the face value, that is the amount that will be repaid back at the end, at the duration of the bond. So I can leave you to determine this. I can determine the first one and leave you to complete the other ones. So what we have will be price of the bond will be equals to 100 into 1 plus 0.15. So I have now converted this by dividing 0.15 into 4 to have this, and then when you break this down, you have for the first year it is 6.71 and so on, and then arrive at the final answer, which is the final pricing of the bond to be 807.36. You can go back and compare what figure we have now to the pricing when interest was paid only once annually. You will see that there is a difference between this price that we are arriving at and the price when interest was paid only once annually. So now we can now move on to costing of the bond. We can now move to costing of the bond, which is the same thing as what we call the yield. We can now move on to costing. What we just finished is the pricing. So we are moving to costing, which is the same thing as the yields. And then there are two types of yields. There is what we call the approximate yield to maturity, AYTM, and there is the yield to maturity. The approximate yield to maturity. By the way, what is the costing and what is the yield? What is the costing and what is the yield? The costing here is the cost of funds for the borrower. When the borrower approaches the lender to borrow funds, he or she is not borrowing the funds just to spend. He or she is borrowing the funds to invest, maybe to carry out an assignment, maybe to carry out a project that will generate revenue and generate profit. So at what point will the profits begin to come in? That's the costing. That is the cost. Even though the borrower is paying interest to the lender, that interest is paying to the lender is not the actual cost of the funds, because after paying the interest, if you look at other expenses like cost of running the office, cost of paying salaries and all that, they are not inbuilt into the interest this borrower is paying to the lender. So the borrower must look for the appropriate costing of the fund, the level of returns that whatever project he or she is investing this money in, the level of the fund that is appropriate, the level of the fund of the return that is appropriate, in which sense that when this project is carried out, the borrower does not run at a loss at the end of the day. So the yield to maturity is the exact costing. It is the exact costing. It is the exact returns. It is the exact returns. It is the exact returns on investment in percentage. It is the exact return on investment in percentage. The minimum of which the borrower must look at the business or the investment as worthwhile. I said that the yield to maturity is the exact return on investment, which is the minimum at which the borrower or the corporate organization that is borrowing the money must look at that investment they want to enter into as worthwhile. While the approximate yield is approximate, just like the word, is almost exact. It is not the perfect, it is not the exact return, but it hovers around the exact return. It is something close to the exact return. And how do we determine the approximate yield to maturity? The approximate yield to maturity is determined as the summation of the interest at time t plus the face value or the maturity value minus the current market price of the bond divided by half of the face value, or let's call this the maturity value. The maturity value market minus the current market price. Why did I change this from face value to maturity value? Because of that concept that we discussed earlier, where there could be an agreement that the bond may be redeemed at a premium or at a par or at a discount. So these situations made me to change the formula here from face value to maturity value to cater for that condition in which the bond may be retired. So in this case, whatever it is that is the condition for the retirement, if the situation is silent about the condition for the retirement of the bond, then the retirement value here becomes the face value. Otherwise, we are considering the maturity value. So in the previous example, where we had the number of years to be 5, the rate of interest to be 10, and then we calculated, let's say the current market price is 850, and this time the yield to maturity is what is missing. In the pricing, we are looking for the current market price, but in the costing, this time we are looking for the yield to maturity. So in the costing, we are looking for the yield to maturity. So in this case, our interest, like we calculated before, is 10% of 1,000, which is 100 naira. So you notice that in this example, I did not put the 1,000 face value. The information may be silent about it. If the information is silent about it, you should realize that face value is always calibrated. It could either be 50 kobo or 1 naira or 100 naira or 1,000. So if the information is silent about the face value, what you need to do is to come and look at the current market price. Whichever of this calibration the current market price is closer to, that's your face value. If you look at this example, for instance, the current market price is 850, is closer to 1,000 naira. So the face value will be 1,000. Had it been that the current market price is somewhere around 102 naira or somewhere around 85 naira, I would have been able to deduce that the face value will be 100 naira. That's how to determine, that's how to know what your face value is, in case you are not given, in case the information is silent about the face value. And in this case, the information is silent about the face value. And then you need the face value to be able to determine the amount, the interest that will be paid to the lender. So in this case, our interest is 10% of 1,000, which is 100 naira. And then our approximate yield to maturity is then 100 naira plus 1 all over n, which is 5. Number of years is 5, into the maturity value. They did not tell us whether it is going to mature at par or at premium, at discount. So we assume that it is going to be it is going to mature at par. So that's going to be 1,000 minus the current market price of 850. Everything divided by 1/2 of 1,000 plus 850. So what we have is 100 plus 1/5 into 150 divided by 1/2 into 1,850. So we have 100 plus, if you divide 150 by 5, that's 30, plus 30 all over half of 1850. So what we have is 130 divided by half of 1850. Half of 1850 divided by 2 is 925. 925. Everything multiplied by 100 to convert to percentage. So we have 130 divided by 925 times 100. So that should give us 14.05%. That's approximately 14%. So what this is saying is that the rate of return that this investment should carry to make it worthwhile should be is, if we use 14% is not the exact rate that we need, but it is almost the exact, it is close. Well, if we calculate the exact yield to maturity, it will be somewhere around, maybe a little bit higher than 14% or maybe a little bit less than 14%, but that this approximate yield to maturity will be close to the exact yield to maturity. And now we can now determine the exact yield to maturity, which is the same thing as the internal rate of returns. The exact yield to maturity, the yield to maturity is the same thing as the internal rate of returns in capital budgeting.